Before we begin, please support the channel by subscribing, liking, and sharing this explainer. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's dive right in. The source document for today's explainer is the U.S. Market Peripheral Notes, dated Thursday, April 9th, 2026. And just a quick reminder, this presentation is a direct informational narration of that source document. So here's what we're going to walk through today. We'll start with the big picture macro drivers, then get into the nitty-gritty of market mechanics. After that, we've got two deep dives, first on software, then infrastructure, and we'll wrap it all up with a summary and a strategic outlook. Okay, first things first, the risk disclosure. It's really important to remember that this document is for informational purposes only. It is not investment advice. Investing has significant risks, including the potential loss of your principal, and all the views we're about to discuss are for reference only. Let's kick things off with our first section, macro drivers. The key takeaway here is that the market's in a totally different regime now. We're talking about a volatility driven by huge external events. In fact, what's happening in the Middle East has completely shoved Fed policy out of the driver's seat. Geopolitics is the new core driver. And this slide really breaks down the lightning-fast chain reaction we saw. It all began with Israeli airstrikes. That prompted Iran to announce a closure of the Strait of Hormuz. And bam, a violent oil price shock. Crude surged over 8% in a single day. Then you had the shipping giant Maersk immediately restrict passage through the Persian Gulf. Now, some diplomatic efforts created a bit of a pause, and Iran eventually walked back its statement, which let oil prices fall and, well, that set the stage for the market's big rebound. So, while all this geopolitical drama was unfolding, what were the usual economic numbers telling us? Well, as you can see from this table, not much that was useful in the moment. The February PCE data was in line, but let's be honest, that's ancient history now. It's pre-conflict data. Q4 GDP came in at 0.5%, which was weaker than expected, hinting that growth is slowing down. And initial jobless claims, at 219,000, well, they're still showing a pretty resilient labor market. But the big problem? None of this data even captures that massive oil spike. And that brings us to the core issue, doesn't it? Because of this serious lag effect, relying on that traditional data is like trying to drive while looking in the rearview mirror. It's stale news. The market has completely moved on, and its attention is now 100% on the intraday moves being driven by quantitative algorithms. So that's a perfect transition into our second section. Let's dig into market mechanics and really unpack the technical forces that are pushing prices around, because it's way more than just simple sentiment these days. This quote just nails it. The way the modern market works is incredibly structured. What you and I might see as sentiment is really just the tip of the iceberg. The true engine humming underneath is what's called a liquidity vacuum, and it's created by this complex dance between options hedging and those quant algorithms. So how did that actually play out? Well, early in the session, those quant algos were scanning the news flow, and they picked up on keywords like negotiation and peace. Instantly, that triggered a massive short squeeze, a crazy buying frenzy that sent the market soaring higher. And where did that squeeze run to? It ran right up against one of the single most important numbers in the entire market right now, 6840 on the S&P 500. This level is absolutely mission critical if you want to understand what's happening. Okay, so why is 6840 so important? Because it's created this incredible tug of war. On one side, you have the magnet effect. There's a giant wall of call options sitting at this level, and as the market rallies, it's literally pulled up towards 6840. But then you get the pinning effect. As the market gets close, the dealers who sold those options have to protect themselves by selling S&P futures, and that selling creates this powerful ceiling, basically pinning the market right in that spot. This whole situation created a fascinating divide. Look at this. On one hand, you've got the big institutions. JP Morgan turned tactically bullish, targeting 7,000. Goldman Sachs was telling clients to buy the dip in tech. And on the other hand, retail investors. Their trading activity was at a historic low, just the 1.2nd percentile. And the little bit they did do was to pile into short ETFs right before that epic squeeze. The source actually calls them liquidity fodder. Ouch. And right in the middle of all this chaos, something really, really strange happened in the oil market. Check out this timeline. First, a massive $51 million short position gets placed on crude oil. Just moments later, the ceasefire headline drops. And almost instantly, that position makes a profit of $170 million. It definitely suggests a major lack of transparency. Okay, let's pivot and get into our first sector deep dive, software. The big story here is all about a total reconstruction of valuations. The market is grappling with this deep-seated fear that AI is evolving from just a useful tool into a fully autonomous replacement.
And the damage has been really significant. I mean, just look at some of these leading software names. ServiceNow is down a whopping 63% from its peak. On the day of this report, Rubrik dropped 10.6% and CrowdStrike fell 7.5%, and it's all tied to concerns about AI's disruptive power.
This quote from the well-known investor Michael Burry just perfectly captures the threat. His argument was that Palantir spent 20 years building this incredible competitive moat, and Anthropic's AI basically erased it, reaching technical parity in just a few months. The source has a great term for this: technological dimensionality reduction.
And the effect on valuations? Absolutely brutal. This AI threat has crushed software sector valuations, taking them from a multiple of 84 times earnings all the way down to just 22.7.
So if software is getting hammered, where's the capital flowing? That brings us to our second deep dive: infrastructure. It seems the AI hardware space, with what the source calls its hard currency characteristics, is being seen as a relative safe haven for big institutional money.
The CoreWeave story is the perfect example. Just look at the details in this table. The company locked in an additional $21 billion in contract value. That brings their total contract value to over $35 billion. And strategically, they diversified their customer base. Meta is now their biggest client, which actually reduces their customer concentration risk. But the real catalyst, the thing that moved the needle, was S&P Global Ratings changing their outlook to positive.
And this right here is the absolute key takeaway for the entire infrastructure sector. Think about it. CoreWeave has $21 billion of debt, and yet the stock popped 3.36%. Why? It's because right now, the market is rewarding the marginal improvement in credit quality way more than it's punishing the pure quantity of debt. It's all about the direction of the story.
All right, let's pull all these threads together in our final section: the summary and strategic outlook. You know, the big challenge for investors now is figuring out how to navigate a market that's gotten pretty emotionally overextended after rallying for 7 straight days.
And this is the price range you absolutely have to watch: 6720 to 6750 on the S&P 500. This area represents the thickest wall of put options, and it is the bull-bear dividing line that's holding up the structure of this entire rebound.
So that leads to the million-dollar question for investors, right? With all these geopolitical risks still simmering and that huge suppressive options wall at 6840 acting like a ceiling, what's the right strategy as we head into the next big CPI data release?
Well, the source document lays out a pretty clear 3-part strategy. First, it suggests moderately reducing your overall risk exposure. Second, avoid those software companies where the competitive moats are getting destroyed by AI. And third, concentrate your allocation in the leading compute infrastructure names, where there's much higher conviction in their growth story.
To wrap things up, we have to go through the full professional risk disclosure. This document is provided only for informational and research purposes. It does not constitute investment advice, financial advice, or trading advice, or any kind of recommendation to buy or sell any security. The author is not a registered investment advisor.
Any investment or trading decision that you make based on this document is done solely at your own discretion and at your own risk. You are completely responsible for conducting your own independent research. Remember, past performance is not an indicator of future results, and the information you heard today may become outdated without notice.